Welcome to Markets Now. I'm Michelle Rook along with Beadle Paradigm Futures. Well, a mixed day in the grains, mostly lower over in the livestock. And let's talk about soybeans first off. Of course, kind of a disappointing close on Friday in soybeans, but a pop back up today. Was that mostly weather related, or was it kind of tied to some of this export news we saw this morning?
Well, the export news helps, but I think that today's trade was mostly driven by weather. There was some indications last week that maybe we were going to start to get a warmer forecast for the back half of August, and as we get closer to it, it does appear to be more certain that we're going to have a pop in temperatures by the middle of this week in the Western Corn Belt, and by the end of this week in the Eastern Corn Belt. And most of the models have this heat not only returning, but staying for the balance of August and potentially into early September. And since we're talking about temperatures that may be in the low to mid 90s without much rain, we may be undoing some of the benefit of the really good weather that we had in early August. And I think many traders on Friday had anticipated that yields might rebound, say on the September report. This is a weather forecast that will make it a lot more difficult for those yields to rebound.
Yeah, and we don't have a lot of wiggle room with the 245 million bushel carryout figure, do we?
No, that's one of the interesting things, is that we now actually have a forecasted carryout that's below this year's and below the years before. And I think it's important to remember that each of these last 2 years, markets have been exceptionally tight. Basis levels at various points have been extraordinarily strong, and we've had steep inverses in our markets. Of course, we do have a little bit more supply out of South America this year, specifically out of Brazil. But what also is interesting is that they left the Argentine number unchanged at 25 million tons, when their own attaché has it at 21.6, and the exchanges in Rosario and Buenos Aires have the crop something closer to 20 million tons. So the balance sheet itself on a world basis might be 3 to 5 million tons tighter, both in old crop and in next year's new crop.
Okay, well, hopefully that means that the support areas that we've been holding technically will continue to hold. Corn market, so we got kind of caught there between lower wheat and higher soybeans, so a fractional gain of a half cent on the December, but a pretty good close overall. We held those July lows, which we needed to, right?
Yeah, we left a double bottom at 481, and then we have a small reversal higher. That's a good technical start. I'm not willing to say that we're done going down or that the lows have been made. But there are a couple of supportive factors here. Number one, we are at an area that is not worthwhile for growers to sell, because they have revenue insurance products. And prices at this level essentially have all of the downside covered below this price, unless a grower has a much above trend type yield. So you're not going to see a lot of hedging from the farmer. On the flip side, we're adding margin into ethanol. We're putting margin into cattle and hogs. Those margins have improved here the last few weeks with the lower corn price. The only people that seem to still be interested in selling it are the speculators, and at some point they're going to run out of bullets.
No doubt. I have to ask you as well, after the WASDE report, we got an adjustment on demand once again, and there's a lot of people that are really bearish demand on corn going forward. Yeah. Are you in that camp?
No, I'm really not. I think there's one important difference between the last couple of years, when we saw the USDA lower demand when they lowered supply, and this year. Those last couple of years, we needed to lower demand in order to maintain an adequate carryout supply. This year, they're lowering demand from a 2.2 billion or 2.25 billion bushel carryout, and it really doesn't necessarily make any sense because of the margin construct that I talked about earlier, and the fact that we are going to have the bushels available, and we have less competition from Black Sea, and we have issues in China. It just feels to me that, once we get through the flush of Brazilian corn, and we do realize that they need to sell their corn now for space and quality considerations. But the back half of this upcoming year, I think, is going to be pretty good for U.S. exports.
Yeah. Okay, so the wheat market, as I said, initially dragging down corn this morning, but wheat got a lot of problems. It seems like demand concerns, export inspections weren't that good this morning. The dollar was higher. But, that market has gone from being what seemingly was a headline-driven market to acting like it doesn't really care about the Black Sea developments, right?
Yeah. Well, we've really, when you look at wheat, we've been trading this very, very broad trading range for a long time now. And, when we get these headline news and the market rallies, we've been finding speculators willing to sell. When the market breaks, we've been going down to the low end of the range. And, even today, we ended up closing Chicago wheat, an easy dime off of the lows, and those lows just matched up with, with some of the prior lows in the marketplace as well. We agree that it's demand has been a little bit sluggish, but we think ultimately that the issue in the Black Sea is probably more important than the trade wants to give it credit for. The overnight activity, which was initially stronger off of a boat that the Russians stopped. The Russians ultimately let that boat go and continue on to the port in Ismail in Romania, and the marketplace again just kind of shrugged its shoulders. It feels to me that traders believe that somehow the Black Sea is going to stay open, and when we maybe threaten that a little bit more significantly, that's when the market rallies. And we've done that a couple of times here in the last couple of months. And that essentially has defined our large range.
Yeah. And then I think we had a report out that Ukraine since July 1st had moved more grain than a year ago. So that doesn't help.
No, that's true.
Yeah. Let's talk about this cattle market. Of course, kind of a disappointing day here today with everything lower in the face of steady to even some better cash trade up in the north. So,
Right.
Why did the market fail today?
Well, you have to look at the construct of the market and where the speculator sits right now. And they've had a very large long position, but they've been slowly starting to liquidate that position. And for a little while here, unless you make new contract highs, I think that the speculator is going to be looking to sell rallies to continue to reduce the size of that long position. And of course, there is still concern about the economy, and we talk a lot about soft landing, but we do have fairly high beef prices, and we have seen evidence in some of the retail sales and in some of the earnings reports that the consumer is starting to be impacted with inflation and higher interest rates. And so, the cattle is just, seemingly once again, maybe due for a little correction or a little consolidation at higher prices.
Yeah. And seasonal start to turn over here as well. So that could be a little bit of it, don't you think?
Absolutely.
Yeah, and bull markets need to be fed, and I guess you got to have a little bit of bullish news every day to keep them going. Okay, what about the hog market? Cash market or the lean hog index has been trailing lower, but now you have August off the board, and the futures are at this big discount. And so, do we really need for the futures to keep going down?
Well, we're going to be watching the pace of the declines of the CME index. Generally, when that front month goes off the board, you end up getting a little bit of nearby support to the next contract. In this case, the October contract. This is the time of the year when we seasonally do see hog prices decline. And so we generally have a discounted October futures to August futures. So this happens every year. And sometimes you get a little bit of support, but ultimately it comes down to the pace of declines in the CME index. And, we've been hearing things at the cash market suggesting that We may ultimately find a bottom in hogs this year somewhere in the high 50s or low 60s, based on the number of animals that are out there and the way demand constructs are at the present time. And if that's going to happen, then we're probably going to see a little bit steeper decline in CME cash markets, and that's what would make the futures go down a little quicker.
Thanks for joining us. Kent Beadle, Paradigm Futures. That's Markets Now.